All right. My name is Chris Campbell. I'm a practicing CPA and I work with small businesses and individuals to help them pay the least amount of taxes possible while keeping them out of jail. So today I wanted to talk a little bit about this Delaware Corporation stuff. So I had a potential client reach out to me and they had some issues because they opened a number of Delaware C corporations. And as a result, they received a pretty hefty tax bill from the state of Delaware. The client had reached out and mentioned that they didn't really do anything with these companies. So they were relatively inactive, but they were open and they didn't understand, why they owed. And I think it came out of thousands of dollars that they owed the state of Delaware. So I wanted to break that down in a couple of, as far as one, break down why that tax bill was what it was. And two, also just weighing the crux of folks really understanding that probably more than likely don't really need to open or even do Delaware corporations, and kind of the myth behind why you even bothering doing that. I'd say 9.5 times out of 10, you probably have no business even doing that. As far as opening Delaware corporations, you might have heard that, oh, go and get yourself a Delaware corporation because it's going to save you on taxes. And it's just a great thing to do. For 9.5 people out of 10, that is not applicable and not necessarily accurate. You have corporations that do that, but you're looking at multinational corporations that do that. Your Amazons, your Microsofts, your Googles, they're multi-billion-dollar, multinational corporations. If you're not really playing in that field, at least at the moment, maybe you plan to, but if you're not playing in that field at the moment, there's really no business of you even attempting to do that. All you're really doing is spending money you don't need to spend and creating more paperwork for yourself. Delaware is one of those states where you can operate out of there or say that you're based out of there. You can open there without necessarily having to operate there. So it works for a lot of multinational corporations because I'm sure a lot of them have a lot of tax schemes where they pay very little in U.S. income tax, but that also involves a lot of offshoring income and shifting income over to lower tax countries and things like that. But because also the money that you would have to spend to even execute that, most companies aren't even generating enough revenue to even consider doing anything like that. So that's why for most small, mid-sized businesses, it doesn't really make sense to do. Something about this is that when you operating your company, yes, you can do it in Delaware and you don't necessarily have to be in Delaware. However, you do have to register your company, the place that you are actually doing business in. So if you are in New York and if you are physically located in New York and your business is located in New York, you decide to open a Delaware company, you also have to register that company in New York because that's where you're doing business. So pretty much any state will say that in order to properly do business in their state, you have to be registered in their state. Now, you can take a Delaware corporation and register it in any state and it'll be considered foreign corporation because as far as where it was originally located, but you have to file to get permission to do business in that state. And if you are registered in that state, with most companies, LLCs, corporations, whatever have you, you got to pay that state as well. So in this instance where you're based out in New York and you open this Delaware corporation or company, you have to pay Delaware every year because they do charge you every year simply for the right of being a corporation. So whether you were active, not active, you made $10 million, you lost $10 million, you still have to pay Delaware for the right of being in that state, of registering in that state. And pretty much the same thing goes for the state that you're in. So especially as a corporation, again, whether you made or you lost money, most of the states are going to want something from you. Really, as I said, for the right business in that state, you're going to have to pay for the right to do business in that state. So you're paying two states. And for the most part, you're not really getting much benefit from doing Delaware. So quick lesson on that. Don't go and register Delaware just because someone said it was okay to do. You're not really saving anything. You still have to report your income taxes. You'll still have to pay for the right to business in the state that you're actually in. And in addition to pay income taxes in that state, you're not really saving anything. So just avoid altogether doing the whole Delaware thing just because. I would say the one case where it may make sense and you're a smaller entity is if you are located overseas. So I have a couple of clients who operate businesses, but they're U.S. citizens and they're overseas, but they want a U.S.-based company. So in an instance like that, that may make sense because they want a U.S.-based company. They're not physically located in any state. So they'll pay their annual fees to Delaware, and then they just have to report on federal income tax. So that might be the one instance where as a smaller entity, it may make sense to do that. But if you're stateside, I would be avoid doing the Delaware thing altogether. And then that brings me to the taxes. Specifically a corporation in Delaware. So going back to this potential client, they received this tax bill for thousands of dollars and they really couldn't understand why. And I'm pretty sure what happened was Delaware uses two different methods to tax their corporations. And probably what happened with my client was that Delaware taxed them in the least advantageous method for them. But there are two methods that Delaware uses, and you have your option to choose. So you just have to make sure you choose the one that obviously works more in your favor. So the two methods are the authorized shares method and the assumed par value method. All right. So the authorized shares method is a tax based upon the number of shares that your corporation has authorized. And the rate is roughly dollars for 10,000 shares authorized. So for every 10,000 shares authorized, you got to pay $85 every year. And this is probably where this potential client got jammed up because you create these companies and you say, oh, well, how many shares? Well, yeah, I'm going to be super big. So I'm going to create 10 million shares. Okay. Well, you have 10 million shares, $85 for every 10,000 that you do. That quite adds up, even if you do 1 million shares, right? So 100 for 100,000 shares, right? So multiply that by 10, $8,500 for 1 million shares, right? You can easily just go and say, yeah, I have 1 million shares authorized to use because I'm going to go and spread the wealth around, right? So that can get pretty costly, especially if you are a smaller entity with 1 million shares, 8,500, quite a bit to pay. So that's one method. And for most smaller entities, you should probably stay away from that method. The other method is the assumed par value. And what that does is you take all of your shares, you assign it a par value, and you pay based upon the total assumed par value of all the shares that you have outstanding. Now, using this method, you can take those same shares, and if you're not really doing much, give it a small value, say it's a penny per share. That's the par value. So based upon par value, that rate is $400 for every $1 million, right? So if you do the math on that, if you take those same 1 million shares and you give each share a par value of a penny, what does that come out to? $10,000? So being that you're paying upon the total par value and it's $400 for every $1 million. So in this case, as long as your par value stay below the $1 million, you're paying $400. So the 400 is the minimum. So you got to pay the million. So as you see from the example, you take the same 1 million shares, but one method is going to cost you 500. The other method is going to cost you 100. So very different outcomes. So that's why it's very crucial that you use the correct method. Otherwise, you're going to wind up paying thousands of dollars unnecessarily. So there's a quick lesson on that. But like I said earlier in this video, probably if you're a smaller to mid-sized operation, probably shouldn't even be looking into doing the whole Delaware company thing. And like I said, with the exception of if you are located overseas. So hopefully this was helpful. So that's all for today. If you have any questions about this particular topic or any other tax or accounting related questions, feel free to reach out. I'm happy to help. All right. So that's all for now. And I'll talk to you next time.